Welcome back to the Deep Dive. Today, we're taking a targeted plunge into some critical economic insights, straight from the source.
We are. Our focus today is the compendium, the 10 toughest client questions we fielded. It's from UBS Global Economics and Strategy, just published on July 7th, 2025.
Right. And it's designed to give investors these concise, data-backed answers to some really challenging market questions right now.
Exactly.
So our mission for you is to, well, cut through the noise. We're pulling out the most crucial nuggets from this analysis. Think of it as a shortcut to getting informed on the market's biggest puzzles.
Getting those aha moments without digging through all the charts yourself.
Precisely. We're asking, how are these big shifts in trade and fiscal policy really reshaping the economy? And what does UBS tell us about finding opportunities amid all this uncertainty? Let's dive in. Okay, let's start with tariffs. UBS says current U.S. tariffs are like roughly a 1.5% GDP tax on U.S. importers.
That's right. And it's an increase of about $500 billion if you strip out the pre-existing tariffs. The Treasury is already collecting over $300 billion annualized from this.
That's a huge number. A real headwind for businesses and eventually consumers, right?
Absolutely. And what's really striking is what happened in April. We saw the sharp divergence between global hard data, actual economic activity, and soft data, sentiment surveys.
A divergence? How big?
The gap hit a 27-year high right after the tariffs were announced. But then in May, it started to converge again. Primarily because that hard economic data started deteriorating faster than sentiment was improving. Our global growth tracking estimate, it's now running at a really low 1.3% annualized.
Wow. How low is that historically?
It puts us in the 8th lowest percentile. Global growth has only been slower than this about 8% of the time we've tracked it. It's practically scraping the bottom.
So a definite slowdown. And interestingly, UBS notes leading indicators in the U.S. look even worse than the headline figures might suggest.
While Europe, despite being so open to trade, is showing surprising resilience. Perhaps, as UBS suggests, there's some optimism there about more fiscal spending.
But U.S. confidence has taken a bigger hit.
Yeah, it's fallen more than elsewhere. Still sitting about 1.5 standard deviations below where it was back in December.
And all that earlier tariff front-running companies buying ahead the tariffs, that implies weaker growth later, doesn't it?
It does. It's like everyone rushes to buy before a big price hike, creating a temporary boom, but then sales dry up later. Plus, most of the actual price increases from these tariffs haven't even hit yet.
Right.
When they do, we'll likely see even more weakness in consumption and investment.
Okay, that naturally leads to the dollar. UBS seems bearish, cyclically short-term, but not thinking this is the start of some long-term decline. A wobble, not a collapse. Why?
Well, it boils down to some underlying vulnerabilities versus what's missing this time around. The dollar is vulnerable. Look at the U.S. net international investment position, the NIIP.
America's balance sheet with the world.
Exactly. It's at negative 90% of GDP. That's significant. And it points to this huge, unhedged exposure global investors have built up. They hold something like $31.3 trillion in U.S. long-term securities.
Unhedged, meaning they're fully exposed if the dollar falls.
Correct. And we're seeing rising demand for hedges against dollar downside. A BIS study points this out, and we saw it in early Q2 with the euro gaining against the dollar, especially during Asian trading hours.
So investors are getting nervous.
Seems like it. And just to give you a sense of scale, a 5 percentage point increase in FX hedge ratios on just the foreign private holdings of U.S. assets, that could generate $1.25 trillion in USD selling flow.
Wow, that's a tidal wave.
It is. And this is also linked to the cyclical slowdown we just talked about. A weaker U.S. economy means lower interest rates, which naturally pressures the dollar.
Right. It hurts, it flows into risk assets, reduces the carry trade appeal.
And makes hedging cheaper, too.
But if all that's happening, why isn't UBS calling this a long-term structural sell-off like we've seen before? What's missing?
They stress it lacks the sine qua non, the absolute essential ingredient of past extended dollar down cycles.
Such as
broad-based improvement in growth across the rest of the world, and a drop in global risk premia. Without strong, sustained growth everywhere else, this dollar depreciation probably won't last.
So no big structural shift away from U.S. assets foreseen.
It's hard to see that happening right now, which suggests the dollar likely stays relatively strong over the longer term despite these cyclical pressures. Hashtag #3, the elusive tariff impact on U.S. inflation.
Okay, another puzzle. Inflation. Why aren't these tariffs showing up clearly in official U.S. data, like CPI and PCE? We see hints in private data, like Adobe's index or Nielsen's numbers.
Yeah, where are they? That's a good question. There are several reasons for the delay.
Such as?
First, those loading date exemptions. Imports loaded before the tariffs hit weren't immediately affected. Second, inventories. Firms stocked up beforehand.
So they're working through cheaper stock first, reluctant to raise prices yet.
Exactly. Also remember, over half these tariffs are on intermediate and capital goods, not finished consumer products.
Right. Things used to make other things.
Yeah.
So the price increases take longer to ripple through the supply chain to us.
Precisely. And then there's just the way CPI is measured by monthly sampling, monthly arithmetic. It naturally spreads price changes over several reports.
So when does UBS expect to actually see it in the numbers?
They're looking for a notable pickup in monthly core price changes around the July CPI data, which comes out in August, maybe even a month or two after that. They point to the 2018-19 experience with washing machine tariffs as a similar case of delayed pass-through. Plus, you've got seasonal adjustment factors kind of skewed by the pandemic years that are holding down the May and June core CPI numbers right now.
What about exporters? How are they reacting? That Q1 front-running, followed by the sharp drop in imports in April, must make it hard to read the trade flows clearly.
It really does complicate the picture, and there are these persistent large gaps between what the U.S. reports as imports and what global trade data or even shipping container traffic suggests. It's still a bit of a puzzle.
Okay, but the core question, who's eating the cost of these tariffs? Exporters or importers?
Well, based on the data UBS has looked at, there's virtually no evidence foreign exporters are lowering their prices to absorb the tariffs.
So, like in 2018-19, it seems U.S. importers are largely bearing the direct cost.
That appears to be the case. Now, foreign exporters might have absorbed some of the hit from the dollar's depreciation on their profit margins, but that's a separate, though related issue from absorbing the tariff itself.
And any sign of transshipment?
Yeah.
Rerouting goods through other countries to dodge tariffs.
No clear signs of that in the data so far, but look, it's probably still too early to completely rule that out as a strategy down the road.
Let's talk fiscal. UBS makes the point that most of the change in the U.S. deficit outlook isn't really new news. It's mostly about extending the 2017 tax cuts, which was kind of expected.
Right, so the fundamental outlook hasn't drastically shifted based on recent headlines alone. What is interesting, though, is the Treasury curve, specifically the 2S10s spread.
The difference between 2-year and 10-year yields, it's steepened.
It has. And it's pretty much in line with its old relationship to the 2-year yield from before 2013. This suggests it's not just about supply concerns driving yields higher.
What else, then?
Maybe investor caution. Think about the pain from the bond sell-offs in 2021 to 2023. Investors might just be wary of super low long-term yields now, demanding a steeper curve.
So less about a flood of new bonds, more about demand dynamics. UBS sets a floor for the 10-year yield.
They argue 2.75% should hold, even in stressed scenarios. And they don't see a big pickup in duration flow, meaning major shifts in long-term bond issuance or positioning until after 2027. Gross coupon supply looks flat for 2026.
And historically, demand swings matter more than supply swings anyway?
Much more, typically. If slowdown fears rise, domestic demand for treasuries should be enough to soak up supply. The supply worries seem exaggerated for now. They could become more of a thing later, maybe late 2027, 2028. But for now, demand seems adequate.
What about reallocation? People moving money from U.S. bonds to, say, Europe?
UBS doesn't see much evidence of that being a major driver either. If large flows were going into European bonds, you'd expect German bond term premiums to fall sharply, and they really haven't.
Okay, staying with flows, there's this widely held idea that foreign investors are pulling back from U.S. assets. Is there hard evidence?
There was some, yes. Looking at the April USTC data that tracks international capital flows, foreigners did sell a net $50.6 billion in U.S. long-term securities.
The most sense.
Since April 2020, right at the start of the pandemic shock. It included selling in both equities and treasuries, and central banks, especially some Asian official institutions, were notable sellers, offloading around $30 billion.
Okay, so April saw definite outflows. But what about since then? Has the narrative shifted?
It seems to have evolved, yes. The talk now is less about outright selling of the actual stocks and bonds, and more about global investors increasing their FX hedge ratios on their existing U.S. assets.
So holding the assets but reducing the dollar currency risk.
Exactly. And if the U.S. economy weakens further and rates fall, that would likely spur even more of this FX hedging.
Makes sense. What about foreign direct investment, FDI? We hear about big commitments.
The data doesn't really back up a huge surge yet. Current cross-border M&A announcements are actually running below the 5-year average.
So the bottom line, foreign investors will still need to finance the U.S. current account deficit.
They will. The crucial question, as UBS puts it, is at what USD price they'll be willing to do it. That's the leverage point.
Let's pivot to equities. UBS has a benchmark position on the U.S., but is overweight Europe. That brings up the whole U.S. exceptionalism debate. The U.S. usually outperforms in global slowdowns, right? Lower operational leverage.
Typically, yes. But this time seems a bit different. U.S. GDP growth is actually slowing more than Europe's right now, and European macro surprises are holding up better.
Yeah.
Performance hasn't fully reflected that yet.
And the tech factor.
Yeah.
The U.S. market is heavy tech.
It is. 43% of U.S. market cap versus about 12% for the Euro stocks. Tech doing well usually means U.S. outperformance. But, UBS points out, the Magnificent Six aren't abnormally cheap anymore.
And they face headwinds.
Maturity, higher capital needs, more regulatory scrutiny, reasons for potential derating.
So where does the U.S. look, well, less exceptional compared to Europe right now?
A few key areas, according to UBS. Valuation is a big one. Europe's sector-adjusted PE ratio is 25% cheaper than the U.S. Historically, that gap is usually around 7%.
That's a significant discount.
It is. Then there's the currency for unhedged investors. A weaker dollar typically helps European stocks outperform U.S. stocks in dollar terms. Historically, a 10% drop in the dollar has meant about 6% EU outperformance.
And fundamentals. Fiscal, savings.
The U.S. fiscal position looks weaker. It needs almost double the fiscal tightening Europe does just to stabilize its debt-to-GDP ratio. And European households have way more excess savings, about 10% of GDP versus maybe 2% in the U.S.
Some trends are converging too, like buybacks.
Yeah, U.S. buybacks as a share of market cap are now basically on par with Europe. They used to be much higher. And UBS actually forecasts EU GDP growth to slightly beat U.S. growth in 2026.
Still, the U.S. must have some advantages remaining.
Oh, absolutely. Long-term productivity growth is still much stronger in the U.S., 6.7% versus 0.9% in Europe since COVID, although that gap might narrow. And potential U.S. deregulation is significant, maybe $1.8 trillion in value, but arguably a lot of that is already priced in.
So a more nuanced picture than just U.S. exceptionalism. Okay, let's touch on the One Big Beautiful Bill Act, OBBBA. UBS sees it boosting U.S. growth near term.
Yeah, adding about 0.45 percentage points to real GDP growth over 2025 and 2026 combined. So a modest near-term positive.
And the fiscal impact.
Oh.
Adds to deficits, then narrows them.
That's the CBO projection relative to current policy. Adds to deficits through 2026 and flips, reducing them by $0.4 trillion over 10 years on that basis. But, and this is crucial compared to current law, where many tax cuts would expire, it would increase deficits by $3.4 trillion.
The baseline matters.
Yeah.
What are the main parts of the bill driving the impact?
The expanded business provisions from the 2017 Tax Act, things like full expensing, the R&D tax credit, they have the biggest deficit impact initially. The big near-term pay-for comes from student lending cuts, largely due to how they're accounted for.
And some retroactive bits.
Yes, things like the child tax credit expansion, a bigger deduction for seniors, new deductions for tip and overtime income, those are retroactive, so they'd boost tax refunds in 2026.
Looking back at the 2017 tax bill, did it boost investment significantly?
It gave it a bit of a lift, but it faded pretty quickly. Other things, like the tariffs back then, complicated the picture.
So comparing OBBBA to past stimulus.
While it helps growth near term, its size and duration are much more limited than the huge fiscal support we saw during the previous administration. And importantly, this is all separate from the ongoing tariff impact, which is effectively a big tax hike happening at the same time. #tag9, central bank responses to global tariff escalation.
All right, finally, central banks. How are they reacting to this whole tariff situation? What's changed?
Two really big surprises since early April have shifted the landscape for them. First, the significant U.S. dollar depreciation we talked about. Second, a general lack of retaliation against the U.S. tariffs, Canada being the main exception.
And those two things change how central banks see the tariff shock.
Fundamentally, it means the shock looks less stagflationary, high inflation and slow growth, and more like a straightforward negative growth shock.
Okay, and if it's mainly a growth shock?
It gives central banks more room to lean towards easing policy, towards cutting rates. Market pricing reflects this, and UBS forecasts also show lower policy rates now compared to before early April.
What about the Fed specifically? They seem to have a tougher job.
They really do. UBS expects inflation to rise more than unemployment due to the tariffs. Normally, policy rules would point towards rate hikes in that scenario.
But they seem hesitant.
They appear inclined to prioritize the labor market. They seem willing to tolerate the tariff-related inflation bump, viewing it as a one-off price level adjustment, not persistent underlying inflation.
Right. Their June projections showed higher inflation forecasts for 2025, but they still penciled in 2 rate cuts.
Exactly. It's a very delicate balancing act for them.
UBS has that deep speak model analyzing central bank communications. What's it showing?
Interesting shifts. The ECB, for instance, turned significantly more dovish after early April. Growth concerns really solidified for them as those tariff inflation fears eased.
And the Fed.
Net sentiment there is largely unchanged. Inflation concerns went up, growth concerns went up too, kind of offsetting each other, plus the labor market remains resilient in their view.
Bank of Japan.
For the BOJ, growth concerns are starting to become more dominant. That fits with the idea that any BOJ hikes might come later than people were thinking, especially if global growth keeps softening in the second half of the year. Hashtag deep comments and questions.
Okay, let's dig a bit deeper into a few key points. First, that delayed inflation impact from tariffs. You mentioned UBS expects it to show up later, maybe starting with July data released in August. What if that pass-through, when it finally happens, is sharper or faster than anticipated? How does that hidden pressure affect the Fed?
That's a critical risk, absolutely. We already expect consumption and investment to weaken as prices eventually rise. But if that rise is sudden and sharp, it puts the Fed in a really tight spot.
Because they might be behind the curve.
Exactly. If they've been prioritizing the labor market, viewing inflation as a one-off, they could underestimate the actual impulse. It really complicates using standard policy rules when the data itself is delayed or distorted by inventories and methodology. They could find themselves chasing inflation that built up almost invisibly.
Right. Okay, second point. That unhedged foreign exposure to U.S. assets and the rising demand for dollar hedges. If the dollar does keep weakening because of slower U.S. growth and lower rates, what does that mean for global capital flows? Could it get messy beyond just simple hedging?
It certainly could increase volatility. Think about it. A persistently weaker dollar doesn't just affect portfolio values, it hits the competitiveness and profits of foreign companies doing business in the U.S., even if they initially absorbed the FX shift.
So it could trigger bigger adjustments.
Potentially. It raises that fundamental question we touched on. At what price, what exchange rate are foreign investors willing to keep funding the U.S. deficit? If they demand a higher price, meaning a weaker dollar or higher yields, it could lead to more significant shifts in demand for different U.S. assets, maybe moving away from treasuries towards something else or demanding higher risk premia. It could go beyond just adjusting hedge ratios.
Okay, final deep question. We talked about Europe looking cheap relative to the U.S., having a better fiscal picture, more savings. How sustainable is the U.S. market's exceptional run, especially thinking about that OBBBA boost feeding into a potential fiscal drag in 2027?
That's really the multi-trillion-dollar question for investors, isn't it? The case for Europe looks compelling on several fundamental grounds. Investors might really need to rethink those traditional U.S. outperformance drivers, especially if big tech matures and faces more headwinds.
And the market might not be fully pricing in the U.S. long-term fiscal challenges, or the smaller scale of this latest stimulus compared to past ones.
It's very possible. When you put it all together, the valuation gap, the shifting macro surprises favoring Europe, the fiscal realities, the converging buyback trends, it certainly raises doubts about how long the U.S. exceptional narrative can persist. A rotation into undervalued European assets seems like a very plausible outcome if these trends continue. The U.S. premium might just be running on borrowed time.
And that wraps up our deep dive for today. We've unpacked some really complex economic questions, pulling directly from that UBS analysis to give you, hopefully, a clear view of the forces shaping growth, inflation, currencies, and equities.
Yeah, the goal was to offer those unique insights, help you look past the headlines to the underlying drivers, and navigate these markets with a bit more confidence.
So a final thought for you to consider. As all these dynamics trade, central banks' fiscal policy keep evolving, maybe the real key isn't just forecasting the numbers. Maybe it's about understanding the subtle behavioral shifts, like those hedging decisions, and what they imply for the long term.
A lot to think about.
Indeed. Thanks for joining us on this deep dive.